Hello everyone, welcome to Student Fund Manager. I am Tuhin Shubro Sarkar, and in this video I am going to discuss with you SBI Fixed Maturity Plan or FMP Series 66. Let's get started. So in this video we are going to take an overall look at the fund. We will look at the investment timeline. Then we are going to see the expected returns from the benchmark. We are going to see how we pay less taxes with SBI fixed maturity plan compared to normal fixed deposits. And then we are going to determine who fixed maturity plan is suitable for. So as I have previously discussed, the name of this fund is SBI Fixed Maturity Plan FMP Series 66, and it is a close-ended fund which is currently accepting investments, and after this fund stops taking investments from 11 July this year, new investments will not be allowed and you will receive the maturity amount on the date of maturity, which is 2nd April 2026. And also it is a debt fund predominantly investing in government securities and other such highly rated bonds, and also it contains very low credit risk since the ratings of these bonds are high, and these can be considered as safe investments. And the minimum investment for this fund is 5,000 rupees. So coming to the investment timeline, you can see that the NFO started today, which is 7th July 2022, and the NFO will end at 11th July 2022. So during this time, you can make investments in this fund. And after 11th July, the funds will be closed from investments, and the allotment of the units will be done on 12th July 22. And the investor gets their net asset value on NAV on 19th July, and this fund will mature on 2nd April 2026. So coming to expected returns, the benchmark for this fund is CRISIL Medium Term Debt Index. And this benchmark has provided a CAGR for last 3 years of 7.16%, which is annualized. And in total for the last 3 years, the benchmark has delivered 23.08% returns. So as I was saying, this fund is good for decent returns without taking much risk. But apart from that, we can also save more taxes than FD. Let's see how. The investors in this fund enjoys tax benefits through indexation. Now what is indexation? Well, indexation is used to calculate inflation. And for you, this means you will not have to pay taxes on profit which is actually lost to inflation. For example, suppose you invest 1 lakh rupees in SBI fixed maturity plan and you experience the category returns which is 23% in last 3 years or 23,000 rupees. Now suppose the inflation in those 3 years is roughly around 6% each year, and in total around 18%. So what happens is you only pay the taxes on returns which is more than inflation. So you will not have to pay taxes on the whole amount which is 23,000, but rather you will be deducting the profit which is lost due to inflation. So there was 18% inflation on 1 lakh rupees, which comes down to 18,000 rupees. So it is deducted and you only pay taxes on 5,000 rupees. So over here we have compared the returns of SBI FMP compared to fixed deposits, and we have assumed returns to be at 23% and the individual tax slab of the investor at 10%. So the investment amount is same for both the cases. We are investing 1 lakh rupees in each of these funds and we are realizing returns of 23% on both, that is 23,000 each. Now SBI fixed maturity plan has an indexation benefit. So in case of 18% inflation, you will be getting an indexation benefit of deducting 18,000 from your gains. However, there is no benefit in fixed deposits. And for debt fund gains, you will have to pay a tax rate of 20%. Whereas in case of fixed deposits, you are going to pay taxes on the entire profit under your tax slab. And for this example, we have considered it as 10%. Next, when we calculate how much tax you are going to pay, we can see that 23,000 is your realized gain, but you are taking an indexation benefit of 18,000. So when you take 20% out of 5,000, you get 1,000, which is the tax that you will have to pay. But in case of fixed deposits, you are paying 10% on this entire 23,000 rupees that the fixed deposit has returned. So you will be paying a tax of 2,300, which is more than twice the amount you are going to pay for SBI FMP. So the total returns will be 1,300 rupees higher in this example compared to fixed deposit. So from this example, we can figure out that FMP will provide better return than FD if they experience same returns in this scenario. And even after we have considered the individual tax slab, half of what you are paying for this debt fund will still come out paying more taxes in case of fixed deposits compared to SBI fixed maturity plan. Now coming to the suitability of the firm, this fund is suitable for investors seeking income with capital growth over the tenure of the scheme, and a fund which invests in debt, money market instruments, and government securities, which have fixed returns by nature, and also an investment with higher return compared to FD, but at the same time, much lower risk compared to equities. So that was all about SBI fixed maturity plan. As you may be well aware, I am working in SBI Mutual Fund as an intern. And in case you want to invest in this fund or for any other queries, you can reach out to me. And as for our student managed fund, I will be sharing the returns of our fund at the end of this week, which is on Saturday. So that's it for today. Thank you so much for watching, and I will see you soon. Bye bye.